All right. I am here with Tracy Holland, the founder of Inner Fifth and Goodwill Brands. How's it going, Tracy?
Great, thank you.
Yeah, I'm really excited to get to your successes. But before we get there, let's talk about your background. How did you get
Sure.
into business?
I've always been an entrepreneur. I had a business partner when I was in my 20s who had invented as a scientist scented nail polish. It was the first ever in the
Whoa.
history of the world scented nail polish. And I helped her monetize and commercialize that. And it wasn't hard at the time because when you say scented nail polish and then you actually paint someone's nails and they smell like roses or chocolate or baby diapers in the case of Spencer's, we had all these crazy flavors and scents. It made building a revenue model pretty straightforward because people couldn't believe that it actually worked. And it gave me the opportunity to get to know a lot of different retail channels and a lot of different retailer behavior, which then led me to create an incubation company that co-created brands with retailers and with talent.
Nice. Nice. So really understanding distribution early on, like how it worked, all those conversations, it was pretty key. And I was really excited to learn more about that as we talk. But let's talk about Hatch Brands. Like what was the starting of that? Was that after the sort of
Yeah.
co-creation model that you were doing? Did it come out of that?
Yeah, what I found with retail, and I think getting to do scented nail polish at the time gave me access to retailers in a different way than most people have access. Most people come in with their product and they try to sell it, and there's this very vendor relationship structure where they're kind of the gatekeeper and you're hoping they'll take your product and sell and you can sell your product to them. But having the initial relationship that I had fundamentally based on such a unique innovation made the relationship and the friendship, frankly, that was developed with each of these retail partners a real part of the process of building and growing and hearing from them what their pain points were in terms of other lack of innovation across category. And so the retailers would say, wow, this is such a category disruptor for nail. I wish I could have a category disruptor in the area of body wash or of color cosmetics or of hair care. And that disruption request or the need for uniqueness or innovation was coming from two main points. Point number one was most of the suppliers who supply programs are very large CPG businesses that are slow movers, like L'Oreal and Unilever and all the big guys. So those long lead times for innovation being 36 months drags out the process. The second inhibitor, I think at that time in particular, was that it was not affordable to do business with large retailers as a small CPG business because how could you fund and finance growth? And at that time, I think retail and now even today, retailers are so eager to have a unique point of difference. And now there are all of these financing instruments that allow you to fund growth in a non-dilutive way. And so the market has really, I think, optimized for creator content brands, for digital co-created brands, for retailer unique opportunities and brands. And that was really the genesis of Hatch Beauty. In 2009, based on the feedback from retailers from Dillard's and Macy's all the way down to Walmart, Sam's Club, and Costco, there was this high, insatiable need for point of difference and uniqueness. And it really did breed this concept of, is there an adjacency or a sidecar or a think tank model whereby instead of sitting and trying to figure out what the consumer wants to buy, could we be using retailer data and extra care card data and VIP shopping club data from those that have it from their four walls? Could we be using that to interpret what the consumer trend is going to be and then co-create against it? And
Nice.
that was really the genesis of Hatch Beauty Brands. We didn't know it would work, to be candid. We had no idea if it would actually work. But what we found was having the agency that we had at the time, which was co-creating brands and doing a lot of design and innovation work with brands themselves as clients, it gave us a window into what the brands needed and wanted in terms of co-creation and innovation and design. And so what we did is rather than focus on doing it for a gun for hire on a service agency model, we turned our attention and our focus to how do we co-create this with retail, whereby we act as a sidecar or an innovation engine on behalf of, but we own all the intellectual property, we own the brand, we own all the inventory, and then we can co-create with the retailer having or de-risking the retailer's interest in the brand by taking all of that off their plate and doing it for them.
Nice. Nice. So using data to basically protect their downside, put products in the store that you know are going to sell through, and there's going to be a lot of people interested in it. That's really, really cool. I think when it comes to the founding stories, I'm always curious of how people kind of spark the initial idea. So I get that piece. How did you kind of build the team? Was it, overnight you had a group of 10 people? What was the hiring story kind of like with the team?
Well, I really actually encourage many women who want to be entrepreneurs to keep their day job because I think that there are so many cash flow compression issues in the first couple of years of building and scaling. And one of the most expensive parts of building and scaling is key talent. And so, how do you afford key talent when you yourself need to eat, right?
Mhm.
So, we had this agency model that was pretty cash flow positive because you don't have inventory and you're really on a service basis. So we maintained the agency, and that was underpinning our cash flow for our team. And we would basically borrow time. So if we started at 8 in the morning, we'd work on agency projects until 1 or 2 in the afternoon, and then we'd switch gears and put the team against the programs that we were building with retail and do that from 2 to 7 or 2 to 8. And I
Mhm.
think in a startup culture, there's a certain DNA of a type of employee that really loves the build. So they don't look at the clock. They're not coming in and saying, hey, you hired me from 9 to 5 and I'm here doing creative work or building concepts from 9 to 5 and I'm clocking out. And that is incredibly helpful if you have a team of people as you hire who are really willing to wear multiple hats. And it is a certain profile of person. So that is how I afforded to build and scale. That's how I afforded to build and scale was I used the cash flow from the agency to be able to support the business and the growth.
Okay. And let's start talking about how the exit started and what that was like. Was it a timing thing for you personally? Was it a retail conversation? How did that begin?
I think my business partner and I think if I could hindsight for those listening about what you're doing in terms of building a business, I think having a conversation up front about exit day one is imperative for success on an exit because an exit is already fraught with so many challenges as they're looking at your business model, they're under the hood on customer concentration, whatever the issues may be. So being aligned with your partner on what that exit process looks like, who stays, who goes, how the exit will be run, who goes to the meetings, how you position yourselves is all mission critical to have that conversation up front. I'm talking like the first 6 months of starting your business, just like you would talk to a spouse about how they believe in parenting or what it means to them to have disciplinary practices. You want to understand that before you have kids. And in the case of Hatch Beauty, my business partner and I were always clear that we wanted to exit the company and that we had a financial metric or a trigger point for which we would start to think about and cultivate an exit strategy. And so we did track to that really and adhere to that really in a committed way because we had had the discussion up front.
I like that kind of setting the expectation up front, and then as it progresses, you can kind of back into that. So when it came to timing, I think a lot of people ask all the time about when the right time for them to sell is. And I know every business is different, every founder is different, but for you, what kind of tips could you share around why it was the right time for you guys?
Well, I don't know if we actually did it the first time we went to market, we went out and we pulled the business off the market after having gone out and done a whole series of meetings with maybe 40 different prospective buyers. And one thing I didn't realize that I think is an important thing to talk about that could be useful for your listener is when you're looking at a very hockey stick trajectory or growth, and what we had said to each other is, listen, when the business hits $50 million on a run rate with an EBITDA of 18% or greater, we're going to go out and start to look at buyers and hire an investment banker and have prospective meetings. So we stuck to that plan. What we didn't realize as that hockey stick was going so quickly is that that $50 million year was rolling us into an $80 million year. And so what we got as we got our LOIs in on the first round is priced off of our $50 million year because we were looking back at the former 3 years and they were coming up with their offer based on the number of the revenue and the increase in the pattern of the 3 years prior. But the reality is, if anyone does the math and you're selling for 4 times top line, are you going to sell at 50 million in the hindsight, or you want to sell off 80 million in the hindsight, right?
Mm-hmm.
So after we had received our first round of LOIs and we were seeing that they were pricing us on the highest, I think, offer that we had received, they had put us at a value of, at the very top of the game, 80 million. So the offer was off of basically an $80 million upside. I knew that within 12 months, I would be at 80 million with 140 million upside, right? Because our run rate was growing at such a clip. So we made a really tough decision. And frankly, my partner and I at that time were not aligned on the decision, but we
Mm-hmm.
made the decision to pull it off the market and wait a year before we went back out. And I would tell anyone listening to this again, I would not recommend that approach, because what you've done is you've exposed your entire processes, all your trade secrets, all your customer profile, all the pricing data. You've exposed that to the market by way of your SIM and your data room, even if you have multiple layers of a data room. You're really showing people how you do business, and you're giving people a lot of intel. And yes, there are non-disclosures that, SIMs are not to go out to people who they are not intended to be given to, but that is not how it works. And your SIM ends up in the hands of your competitors, and your SIM ends up in the hands of prospective competitors who are trying to figure out your business. So being very thoughtful about your timing and being totally aligned with your partner to the execution of the deal getting done and across the finish line is mission critical, I think, overall.
Yeah, I like that because the idea of really just the vulnerability, putting everything out there, getting on market, talking to people, and getting the sim in so many people's hands is a risk. It's baked into the whole process. So going off market creates, even with those initial buyers, it creates like a sense of, I guess, fear of missing out later, but they're also, have seen seen the delicate information. So I can see how that would be pretty scary there. In terms of preparedness, let's talk about that for a second. With getting prepared, getting the data room, because you briefly touched on that. What types of tips can you share around preparing to go through the process?
Well, I think one thing that no entrepreneur really believes is that their company is going to be sellable. And you kind of can't believe or imagine that somebody else is going to want to come in and buy it, right? Especially if you're self-funded and your growth is on your own terms. I think those who come in the beginning with VC funds and investment funds have a more sophisticated group of investors, and the exit is much more mapped out than two entrepreneurs who are kind of starting a business with a big idea and not a lot of working capital. So I'm going to put myself in the bucket of really brilliant entrepreneurs who are visionaries with no working capital and can build and scale something quickly and successfully and profitably. You all of a sudden have a real bull by the horn. And yet there's so many learnings along the way if you haven't done it before. So I would say the one major thing to think through is understand that you're building a business from day one that is going to sell. 100% of entrepreneurs will exit. You're going to exit walking out the front door, or you're going to exit flat, being because everyone has only so much time on the earth. So I really encourage now every entrepreneur to say from day one, and I don't care if you own a nail salon, you own a juice bar, or you own a major CPG brand that's selling in all the major retailers, you will exit. So start to think from day one, what does that exit look like? And what does it mean for you to walk out the door? And under what terms do you want to walk out the door?
Hmm.
Because you're going one way or another.
Yeah. Yeah. I like
Right?
that. Yeah. I like that. Whether it's a dollar sign or flat, it just doesn't matter. You're exiting regardless of how you look at it. I think
Correct.
that is well said. So when it came to negotiations the second time around, what did that look like? You and your business partner were clearly on the same page. How did that process run the second time around?
I think that it was a learning process again the second time around because sizably we were far bigger and much more profitable and I would say a much higher, more lucrative target because we were rounding the corner to the $100 million mark in around 17 to 18% EBITDA margin. So all of a sudden we became like on a different level or threshold for sale. And that brought a whole nother level of sophisticated buyers, right? Because not only were we at the stage where PE was interested, but we had multiple strategics at the table. And what I didn't know because I didn't know yet was that strategic buyers are a much different buying relationship and conversation than a private equity partner is. And it's mission critical for you to understand the differences and what they need to hear in order for them to be comfortable as a strategic with you as an acquisition partner. So I didn't understand and know that at the time as well as I now know that. I would say that's true of my partner as well and our C-suite because when you go to sell a company, especially a company of that size, they're not buying the founders, they're buying the team. They want to know that the team is going to stay put, everybody's going to be locked in. And there's a lot of conversation around, do we tell our team we're doing this? Or do we do this in secret or hide it up until kind of the last minute, with the exception of the CFO? Do we involve the team? Do we not involve the team? I think I have a lot more to learn about the pros and cons of what other people would say. We made the choice to bring our team into the process, which I thought at the time was a really good decision. I think that the fallout of that is that you have the next level of member of the organization seeing that something's wrong, that the team's not paying attention to the business the way they normally do. They're distracted. They're in lots and lots of meetings, and nobody really knows what meetings they're having and why and what it's about. So it causes it causes disruption. And I think minimizing that to the extent that you can is really, really key. But the second time around, my partner and I had to learn on the job, so to speak, what it meant to sell to a strategic and what it meant to ultimately involve the team versus not.
Hmm. That's a really good intel because I think I've heard that a lot on the pod and personally have had that in the past where you don't know what to discuss, what to share, because it could be at the risk of everyone involved. And I think it's such a good point to bring up around team because it's so crucial that the team is involved going through the transaction. And that brings me to my next question around how many people stayed. Did the whole company come over? How was the transition process for everyone?
We were really well guided to have everybody incented to stay and then
Hmm.
incented to stay even longer after the close of the transaction. And we took and heeded to that advice, which in hindsight, I'm grateful we did, because as you know, I really am a huge believer that when you have hockey stick growth with a business, there's no way that that's a founder led success. It's a stew, right? It's a fine perfect balance between the visionaries and the leaders of the company and the founders and those who are there to integrate and execute on behalf of. And it's a perfectly aligned dance, right? And when you start like a Jenga puzzle, when you start to pull out pieces of that infrastructure and that becomes at risk, the entire thing becomes at risk,
Mm-hmm.
especially in the business of co-creating brands and uniquely developing newness with retailers. You're not selling the same product year over year, 5 years in a row. You're really leaning heavily on innovation.
Mm-hmm.
And so it requires all cylinders to fire in order for that to be successful. And so I would always recommend to those who are thinking about exiting and do they tell their team that you really make it a rich, exciting opportunity for the team to stay involved and continue to build after the close, because that is the secret sauce
Mm-hmm.
to the success of the next level.
Yeah, for sure. So with the whole process, first piece is how long did it take? And then the second piece is with valuation, how did you derive it? Was it off EBITDA multiple, top line? How, because strategics, like you said, are kind of the golden goose. That's what everybody wants to go after, because it's a beautiful synergy. It's like a relationship. You can kind of see the business go on in the future.
Yeah.
I'd like to think with strategic versus kind of the PE financial route, but yeah, what can you share with that?
I think one of the things that we as entrepreneurs do is I think we undervalue what we build many times. And so we put a number out there to our investment bankers saying we would be really happy if we got X. I would really recommend not doing that. Just like if you had a high stake, beautiful home and you hire a real estate agent and you start telling your real estate agent that you hired, listen, I'm getting a divorce. You know, I'm way over leveraged. I have all of these other debts that I'm trying to clean up and I really need to move this, but I don't want to move it for less than 7 million. What's that real estate agent going to do when they get five, six, seven folks walking through? They're going to say, this is priced. You have a highly motivated seller. The pricing, it has to come within this range for them to be willing to take it. Even if those things shouldn't be talked about, right? I think they are, because it's human nature.
Mm-hmm.
And when you have a real estate agent or an investment banker, they have X number of deals to do at any given time. And the
Mm-hmm.
size of your deal can be a good deal. And then they get a new client. And then the size of your deal is much smaller than the next deal that they're doing.
Mm-hmm.
So I really recommend discretion is absolutely optimal in your outcome, because you could be putting a price on the table, even as an internal dialogue or conversation. You could be putting a price on the table that's way underpricing what somebody's actually going to pay for your asset. So the allow the market to speak, right? You don't know the reason why someone's interested in buying your business. It may not have anything to do with your client list. It may not have anything to do with your current assortment of SKUs or product. It may be an adjacent need that they have. It could be a foreign entity who's looking to establish a US relationship, US based subsidiary, and they're looking for these 20 retailers to be on your contact list, on your vendor list. And that's the value of the asset. And for that, they're willing to pay up to X. And so, one, be discreet with your team, even though they're your team, your investment banker, and your attorney potentially, or your CPA. I would say continue to say, I'm really eager to see what the market would be willing to pay for this. I know privately, internally, I have a number that really resonates for me, but I'm going to be interested to see what the market says.
Mm-hmm.
And just stay brief on that, because as soon as you nail down and say a number, it's on the table and that you've put a pin in the ground and you don't want to do that.
Yeah. Well said. Well said. So that takes us to the finale. Knowing what you know now, what would you tell Tracy 10 years ago?
I would tell Tracy 10 years ago to have an excellent operating agreement that really defines the exit and the expectations for that exit between you and your partner, or you or your shareholders. So an operating agreement that really talks about all the scenarios so that you have an alignment, because there are lots of ways to pay for something. It could be paid in stock, it could be paid on an earnout, it can be paid on cash today and a percentage of cash later. It can be paid out in multiple ways. And so you really, really want to understand your operating agreement and how all of those things work between you and your shareholders and your partner going into an exit. Number one, I would say understand that. And two, I would say enjoy the process of building and scaling something more and not be so hard on yourself and forego all the fun things like vacation and time with your kids. Because at the end of the day, no amount of money is going to change how you feel about yourself and what your life ultimately, the happiness of your life with different zeros. Yes, you get to buy more things and you get to travel more, do have some more freedom, but you are where you are and you
Hmm.
want to enjoy the process and not say, I'm going to sacrifice everything and double down and skip all these important milestones with my life in order to be at the end of this exit and receiving a check, because then I can be happy. Like there's no there.
Hmm. Well said. Well said. So that takes us to what you're working on now.
Yeah, I have two distinct businesses. One is a high performing female entrepreneur membership model that really speaks to those who would be inclined to join YPO or maybe C200 or one of these groups. And that's for women who are high performing, seven figures and above, that really want to supersize and increase their business based on those five people that they can spend the most time with that really influence their perspective and how to think in a high level growth mindset sort of way. And that's called Inner Fifth. And then I also have a shared services platform called Goodwill Brands, where I buy distressed assets and reboot them. And then I build businesses with different diverse founders who I really believe in their vision, and they have run out of runway financially, and I re-up them on the cap table and give them a second breath of what it could mean for them to build and scale while offering resources and connectivity to retailers.
Awesome. And where can people learn more about those two?
Inner Fifth, INNER fifth, .com, and Goodwill Brands is goodwillbrands.com.
Awesome. Well, wherever you guys are listening on iTunes or Spotify, the links that Tracy mentioned will be in the show notes. But thank you so much for coming on and sharing your story, Tracy.
Steve, thank you. I appreciate it.